Hi, and welcome back to the Food Fund. In this video we will be analyzing if Restaurant Brands International stock is a buy. Restaurant Brands International, stock ticker symbol QSR, is just one of many companies we explore on this channel. The Food Fund is focused on all things related to investing in food, beverage, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. We have a lot of goodness to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Restaurant Brands International. Restaurant Brands International was formed in 2014 following the merger between Burger King and Tim Hortons. The company would go on to acquire Popeye's Louisiana Kitchen and Firehouse Subs. Today Restaurant Brands International is the 5th largest fast food restaurant company. It is based in Toronto, Canada and boasts around 6,300 employees. It is also the number 2 stock in the portfolio of Bill Ackman, comprising a huge chunk of his portfolio. Let's dig in to find out more. Starting with the 1-year chart, we see that Restaurant Brands International had a CAGR of about 15%. Zooming out to the 5-year chart, we see that Restaurant Brands International had a CAGR of 4%. Restaurant Brands International share price has fallen dramatically this year. If we perform a backtest comparison of investing $10,000 in Restaurant Brands International versus the S&P 500, we find some interesting results. In that comparison with the S&P 500, $10,000 invested in Restaurant Brands International would have grown to $13,184 or a 4.9% CAGR versus $17,271 or a 9.8% CAGR if invested in the S&P 500. This shows underperformance for Restaurant Brands International. A Restaurant Brands International investment would have also been more volatile with a 28% standard deviation versus 18% for the S&P 500. While the best year performance of Restaurant Brands International at 26% was less than the S&P 500 at 31%, the Restaurant Brands International worst year performance beats the S&P 500. Max drawdown of Restaurant Brands International was 48%, considerably worse than that of the S&P 500 at 24%. Restaurant Brands International also underperformed the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Let's take a look at the fundamentals to find out more. Gross margin is 40%. This is on par with other restaurant companies. Revenue has compounded at around 5% over the past 5 years and has reached over $6.9 billion most recently. Here we can clearly see that the revenue growth has taken off from 2020 onwards. Looking at cash flow, we see a 3% CAGR over the last 5 years for operating cash flow, while capex has grown at a 7% CAGR. As a result, free cash flow has increased at a 3% CAGR. Although there was a rise from 2020 to 2021, free cash flow has continued to trend downwards since that time. Weighted average shares outstanding have fallen over the last 5 years, going from 473 million shares in 2018 to 457 million shares most recently. Restaurant Brands International has done a good job of buying back. Share buybacks return value to shareholders by increasing the proportion of the company they own. This in turn leads to improved per share metrics like growing earnings per share. Now let's view return on invested capital. Return on invested capital has grown from 8.1% in 2018 to 9.5% in 2023. This is interesting given the declining free cash flow. I wonder if the improvement in return on invested capital can continue in the future. Another important metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -38 days in 2018 to -14 days most recently, Restaurant Brands International has gotten less efficient as time has gone on. The good news is that this value is still negative, which means the company has tremendous leverage in negotiating with suppliers and managing their inventory. Now, let's look at Restaurant Brands International's debt. The net debt to EBITDA has increased over the past 5 years, going from 5.3 in 2018 to 6.4 most recently. This is not good. Given the rapid rise in interest rates, the growing debt load is actually more costly. This is something that Restaurant Brands International needs to get control of right now. If their debt problem continues to linger, it could spell disaster for the company as we enter even more challenging economic times. Last, let's explore dividends. The current dividend yield is 3.2% with a payout ratio of 18.4%. Unfortunately, dividend growth has largely been negative for shareholders of this company. Dividends declined at a -36% CAGR over the last 3 years and -19% over the last 5 years. This is the opposite of what shareholders want to see. The fundamentals of Restaurant Brands International are not awful but don't look great. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Restaurant Brands International. It is a restaurant company with a gross margin of 40%. The 5-year revenue per share CAGR is 1% and the 5-year free cash flow per share CAGR is 3%. These are not great numbers. A return on invested capital of 10% is great, but I am not sure this can continue. Next, the cash conversion cycle of -14 days is excellent but has been worsening over time. Concerning debt, a net debt to EBITDA of 6.4 means that it takes Restaurant Brands International nearly 6.5 years of earnings to pay down debt. This is way too long and a huge issue for the company. So from a fundamental standpoint, Restaurant Brands International leave much to be desired. Now let's switch our attention over to valuation. Restaurant Brands International is fairly valued relative to the S&P 500 with a ratio of 1. The price to earnings growth, or PEG ratio, is 2.9, which means that Restaurant Brands International is overvalued relative to their projected earnings growth. While management has done a pretty good job of navigating the company through a tough 2020, the rebound seems to have peaked. Despite growing revenue, free cash flow is falling and debt is rising. While I don't think this is an existential threat for the company, it does seem likely that they will face tremendous challenges over the next 12 to 18 months. As mentioned before, Restaurant Brands International is one of food super investor Bill Ackman's largest holdings. Restaurant Brands International accounts for nearly 17% of his portfolio, representing a $1.8 billion position. I fail to see his allure to this company. Chipotle, in my opinion, is a far better company in terms of nearly every metric. Additionally, Chipotle is a relatively young company and still has lots of growth ahead of it. For these reasons, I will pass on adding Restaurant Brands International to the watch list. Many thanks for watching. What do you think about Restaurant Brands International and its rising debt? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.